Alright, today I'm going to be talking about centralized banking in the United States. So simply put, fractional reserve banking, the model most modern banks use, is the practice of lending out more money than a bank actually has. So for example, if three people all put $1,000 into a bank, the bank should be in theory only able to lend out $3,000 to other borrowers. But with fractional reserve banking, they can lend out much more. So if a fourth person wants to borrow $10,000, the bank will call up the Federal Reserve and take out the loan from them, and they will get their money. However, if everyone were to try and take all of their money out of the bank at that same time, the whole system would crash since they don't have that money in reserve. Usually the Federal Reserve has mandated that at least a percentage of a depositor's money must be kept in reserve, but since 2020, the Federal Reserve has set that percentage to zero. This typically happens when trust in the financial institution deteriorates, and this is more common than one may think. In March of 2023, there were 3 bank runs, and although they were pretty small, it proves that this is a problem that can absolutely happen. Advocates for this model argue that it stimulates the economy as it puts more money into the pockets of people to spend, and it is true that it increases economic productivity in the short term, but to keep up, more and more money has to be printed in order to keep up with the demand for loans, leading to hyperinflation. So our centralized bank in the United States is the Federal Reserve, more commonly referred to as the Fed. Despite having the name federal, its shares are owned by 12 private regional banks, which is seen in the map to the right, with only limited congressional oversight at the national level. These banks are designed to make a profit, not stabilize the economy, and while it does not directly print money, it does decide how much money the US Mint prints. This is an issue as it prints money to give banks loans and has a financial incentive to do so. It was created to resolve economic instability, but its policy failures would contribute to the prolonging of the Great Depression and other recessions later in the 20th century, such as the 1970 inflation, as well as contributed to the 2008 housing market crash. So what are the implications of all this? Well, the fourth largest category in the national debt behind defense, Social Security, and Medicare is interest on debt. This is money that isn't going to social programs, aid, debt relief, defense, or whatever other program you like. And since the federal Reserve is the government's bank of choice, a fifth of that interest is owed to the Federal Reserve. And that money, primarily paid through federal income tax, is funding an institution that since its founding has been decreasing your purchasing power through the increase of inflation. It has an economic incentive to loan to banks who use the fractional banking system. Banks give out more loans to you, which means more money for them through interest, but it also means they have to take out more loans from the Federal Reserve, leading to the Federal Reserve printing more money, creating more and more inflation. When you print money, it doesn't just give you more money, it decreases the overall value of everyone's money. That means any money that you saved will be worth less and less in favor of the Federal Reserve and banks who take loans from it to make more money. They are ruining the purchasing power of your dollar and the value of your savings.